Yeah, still your boy Ramsey Jr. Please, if this is your first time of seeing my video, smash on the subscription button, like, comment, and share to enable you get more videos. And please don't forget to turn on your notification bell to get you notified whenever I drop a new video. Today we'll be talking about liquidity grab and the perfect trade entry. Yes, what is liquidity? Liquidity simply means your money, the money you are entering a market with. You understand? The particular place you enter your market. You understand? So the liquidity is that money, that place you place your money, that place, that demand zone. That is where liquidity is. You understand? Now, but I will equally touch time frame. Yes, I will equally touch time frame. Now, when you look at these charts, you are doing analysis, looking at this chart, you don't need someone to tell you the movement of the market. From here, we have the highest high, we have 2.55, we have 2.5569. You understand? From there, the market has been falling to this place. Now the market is trying to retrace up back. As you can see, we have an imbalance here. The market would like to retrace back and cover this imbalance. You understand? Now, as I've touched about the movement and knowing the movement of the market, you before you enter into a trade, you look for a perfect trade entry. You understand? Yes. But before I talk about that, let me show you what liquidity is. Let me show you in this video. Let me just show you what liquidity is. This is what they called order block, one of the institutional reference points. You understand? This is what they called order block, one of the institutional reference points. Look at this bearish candle. You understand? And this is what they call an imbalance. You understand? This is what they call an imbalance. An imbalance is let me just say that is a particular place where there is no fully agreement on price movement. That is what creates an imbalance. And I said it previously that an imbalance must later be covered. Trade must later come back and cover the imbalance. You understand? Pay close attention. If there's anything you don't understand, do it to notify me through the comment section. I will come and answer. As you can see, this is an order block, and this is a fair value gap, which is an imbalance. So before you enter your trade, you look for an order block. In my previous video, I said that an order block and a fair value gap, they are like twins. Whenever you are doing your analysis, you want to enter your trade, make sure that the order block has an imbalance, has a fair value gap around it. That's where when you know a valid order block. You understand? So looking at this one now, this is a valid order block. Someone can enter into it. But when you look, let me delete this. When you look at this green candle, you find out that this green candle pumps higher than here. So for instance, someone is doing his analysis, and this order block is where you place. This is your order block, and this is where your stop loss is. You understand? This is where your stop loss is. We've covered the whole order block. You understand? We've covered the whole order block. Yes. And this might be, this is a limit order. You understand? This is the limit order. And your plan is for you to join the moving train whenever the market gets to touch here. You understand? Whenever the market touches here, automatically it will start going down. But when you look at this bullish candle, this mitigation block, you understand? It's called a mitigation block. When you look at this bullish candle, this tiny bullish candle, you find that it just touched you just touch your entry, you just touch your order block, which is your stop loss. You understand? Because in this is where your stop loss is. You just touch your stop loss and start going down. This is simply the full definition of liquidity. You understand? This is a simple way in which you can understand liquidity. This tiny candle, this bullish candle, is what they call liquidity, because this is where your money is. You understand? You are saying that this trade will go down. You understand? You are saying that this trade will go down, but looking at it now, you have been stocked out. So for you to stay safe, you make use of time frame. In this time frame, I'm using 1 hour time frame. I'm using 4 hours time frame. Sorry, I'm using 4 hours time frame to do this analysis. This is a live chart. Now let's go over to a lower time frame, because I normally say it whenever you are doing your analysis. After doing your analysis, for instance, you use 4 hours in doing your analysis, make sure you go down to either 1 hour or 15 minutes. It will enable you see the chart well, see the candle clearly well. You understand? It will help you see the candle clearly well. If you look at this now, you see that this is not a trade, this is not an entry. You understand? You see that this is not an entry. There is no entry here, because there is an imbalance here, there is an imbalance here, there's an order block here, and there's another block here. So there are liquidities here, because for instance, when you enter your trade, using this order block, you understand? When you enter your trade using this order block and this fair value gap, looking at it now, it's a valid one. You understand? But getting to this zone, you will be stocked out. If you use this one, getting to this zone, you will be stocked out. You understand? So what I urge you to do now, I'm in 1 hour time frame. You see that there is no entry here. You understand? So what I urge you to do is, before you enter your trade or before you do your analysis, make sure that you are in a safer place. And you look at this now, someone that is not well enlightened in analysis, we enter a trade here thinking that is a perfect place to enter a trade. You understand? Automatically you'll be stocked out, because there is no entry here. You understand? When I was doing it, when I started it, I used 4 hours. Now we have gone down to 1 hour. You understand? You see that there is an imbalance. This is a time frame for you. That is the main reason why you have to master your time frame. After doing your analysis in 4 hours, you have to go down to 1 hour to check your demand zone, to check your institutional reference point, whether is a valid one. Because 4 hours we bring the candles, the whole candlesticks together. You might get discouraged. You understand? You might not see them well in 4 hours, but if you use 1 hour, 1 hour will bring them down, or 15 minutes. As you can see now, there is no trade entry, because if you should use this candle here, automatically you will be stocked out here without any profit at all. And anyone entering into the market, your aim is to make profit and leave the crypto market. Mind you, you are dealing with the big boy. They are smart and clever enough, so you stay safe. And if you don't understand what I say, do well to notify me through my comment section.